So happy Financial Literacy Month. We are so excited that you all are entering this session for the second series of financial literacy. So today we have a wonderful speaker who's going to talk about credit, how to use it wisely. So I hope you guys are ready to take notes. I hope you guys are excited to talk about money, to ask all of the questions. My name is Tiara Bird, and I'm the Assistant Director of Career and Personal Development with VCU Office of Alumni Relations. Before I introduce our speaker for today's conversation, I would like to go over a few housekeeping points. So we will be recording this webinar. So if you joined a little late, or if you missed something, you will have an opportunity to view it again. We will make sure that you have access to the webinar. Also, if you are in the need of live closed captioning, so we want you to make sure that you access the live transcript button at the bottom of your screen. Once you click that, you should be able to see the subtitles from the menu. If you are having issues, please message our VCU alumni chat bot for assistance. I also would like to thank those who were able to submit questions for our panelists while registering. We will try to get to as many questions as we can throughout the presentation, but if you have questions at any time, put them in the Q&A pane of the control panel. Also, if you submitted questions before this presentation today, we have them and we will get to those at the end of the presentation if time permits. Also, well, actually, I want to introduce Amy Pridemore. She will be your speaker for today. She serves as the Executive Director of the Virginia Credit Union Financial Success Center here at VCU. The Virginia Credit Union Financial Success Center employs 9 peer financial coaches and also provides financial literacy programming for various student groups, faculty, staff, and alumni at VCU. In an effort to expand the outreach of the VACU Financial Success Center, Amy is actively engaged in building financial education programs for small business owners and underserved populations in the Richmond area. Amy is an instructor in the Finance, Real Estate, and Insurance Department at VCU School of Business, where she teaches a personal finance course to VCU students of all majors. Prior to her time at VCU, Amy served as the director of the Center for Financial Literacy and Education at West Virginia University, where she was an integral part of building programs and curriculum supporting financial education in the state of West Virginia. Amy, take it away, and thank you so much for joining us today.
Thanks so much, Tiara. Excited to be here. I'm going to quickly share my screen here. All right, can we see my screen now? Are we good? Fantastic. Well, thank you everybody for joining us today. Like she said, I am the Executive Director of the Virginia Credit Union Financial Success Center here at VCU, and I'm really excited to be here to share with you today about how to use credit wisely. So I want to be interactive here. I really like to create discussion. So if you could type in the chat, what do you think credit is? Anybody? It says the chat is enabled now. Borrowed funds. All right. Any other guesses as to what we think credit is? The ability to borrow money, access to funds with interest and time. Yeah, these are all great answers. So my favorite visualization of credit is we have 2 small boys. They're 8 and 3, and so they like to watch animated movies. And we were watching Raya and the Last Dragon, and there is a scene in the movie where the dragon says to the little boy or little girl, I can't remember now, he says, go to the market and just pick things up. And the little boy says, well, I don't have any money. And he says, it's okay. You just pick it up now and you pay later. And so the little boy goes up and he's going through the market and he realizes, he's starting to take things, and the people selling the goods are like, what are you doing? What's going on? And he said, well, they told me that I could buy now and pay later. And they said, well, you can't do that. We don't know anything about you. We don't have any information on you. And I feel like that is the most accurate depiction of what credit is, because essentially it is the ability to borrow money or access goods or services with the understanding that you'll pay later. So that is a really great depiction of what that is. So when we think about our credit scores, we can go anywhere from 300 is the lowest on the scale to 850, which is excellent. There are many, many people who strive to be at that 850, but I don't know that I've ever met someone who has hit it. So it is a really hard number to hit, but really if you're in that 720 to 850 range, that's where we really want to be. So a lot of people get stuck on this number and what does it mean? And, I'm really working to make it better. And, the topic of today's conversation is learning how to play the credit game, right? And that's exactly what we're doing. We're trying to figure out what works best for us to allow us to continually get that credit score better. So when we think about the cost of borrowing, I always tell my students that there is a relationship between risk and interest rate. That if you are if you're with investing, if you're investing in a risky asset, you want to have a higher return, right? So when you think about banks and their ability to loan money to us as individuals, as consumers, when they look at our credit score, it is basically a score that tells them how risky of a borrower we are, right? So they're going to say, if you have an 800 credit score, you're really likely to pay this loan back. But if you're on the low end, like those, 500, 650s and below, there's a really good chance that you might not pay that loan back. So to them, you are a higher risk. So when you think about your credit score, if your credit score is high, your interest rate is low because you're a lower risk to the bank. And the opposite is also true, that if you have a lower credit score, that you're going to have a higher interest rate because you are a riskier proposition to the bank. So those two have an inverse relationship. So again, if we hold all things equal and one person has a really high credit score and one person has a really low credit score, and they both go buy the same car for the same amount of money, the person with a low credit score will end up paying more money over time because that credit score is lower and they're having to pay more in interest to borrow that money. So a lot of people want to know, like, what does go into your credit score? And this is how a FICO score breaks down. And I just see the question in the Q&A that says, is FICO and credit score the same? And the answer is yes, they are the same. So when we think about your credit score as a big pie, right? It's made up of your payment history, how much you owe on those cards, any new credit, the length of your credit history, and how much you have maxed out on your cards. So think about the biggest piece of that pie is your payment history. If you are interested in paying, in building your credit, the best thing that you can do is pay your bills. Pay your insurance, pay your utility bills, pay your credit card bills, continually pay those payments on time, every time, so that you're not missing any payments. So, if you have a credit card and maybe you miss that due date, they're going to not only charge you a late fee, but then, they're also going to hit your credit because you paid late. So that would negatively affect your credit score. The next biggest piece of the pie is how much do you owe. So when you look at your total debt available to you, your credit card limits, let's say that maybe you have a Discover card, a Chase card, and a Lowe's card. And together you have on all three of those an amount of $10,000. What is the amount that you owe on that? Are you trying to keep that around 10 to 12%? Is it maybe 30? Do you have them all maxed out? What do you actually owe on those cards and how much credit do you have available to you? The next highest is your length of credit history. And unfortunately, that's not something that we can necessarily change. But as I teach personal finance and talk to students at VCU all the time, my biggest piece of advice to them is to start building credit as soon as they possibly can. So I was lucky enough that whenever I was in college, I got a Discover student card. I got that my freshman or sophomore year. And I have never closed that. That is the other kicker, is that once you get that credit started, you never want to close that line of credit because it will continue to last for the remaining however long you have that open. So that is my longest standing account on my credit history. So the earlier that you can start building credit, the better that's going to help you. But clearly we can't go through a time machine and make things any faster as far as the years go. And then credit utilization, credit maximum and new credit have the same amount of percentages tied to them. New credit is how many times you are opening a new line of credit, whether that be a mortgage, whether that be a car loan, personal loan, credit card. You don't want to have any more than 1 to 2 of these per year. So for instance, in our family, my husband bought a new car in December of 2021. So, and then we could do another credit card or something, but until that car loan drops off, it's really not a great idea for us to get more than one line of credit or loan in that time frame of a year. When you think about this, is that, if you are opening, what does that say to the banks? That says that maybe you don't have the cash flow needed to sustain your current needs. So you're opening and trying to borrow to affect those and change that. And then how much credit do you have available to you? When you take the total of your loans, whether that be a car loan, mortgage, student loans, credit cards, how much do you have available to you? I used to think that this was a bad thing. When you would get in the mail, they would say, oh, we want to increase your credit limit. And I was like, no, I don't want to increase my credit limit. Why would I want to do that? That's just going to affect me negatively. It actually helps you. So anytime if you do have a credit card that it says they want you to increase your credit limit, or they're going to, absolutely take advantage of that, because that then opens up your credit score a little bit better. I'm going to stop here for a second and look at the questions. I will go back to the build relationship with a particular lender at the end. And how early can you start building credit? Is it possible in high school for your child? So what a lot of people have done is that if they get credit cards, you can add your high school student as an authorized user. So that credit is starting to build up in their name, but until they actually reach the age of 18, they wouldn't be able to get a credit card, but you can allow them to be an authorized user on yours. And okay. And I did both of those. So any other questions before I move on to the next slide? Are we good? All right. So there are 3 different credit reporting agencies. There's TransUnion, Experian, and Equifax. Depending on which credit reporting agency you're looking at, they all have different numbers. They shouldn't vary more than 20 to 30 points, but they all pull on relatively the same, but different. They all have their own specific formulas that they go off of. So don't stress out if you look at your Experian card and it says you have a 780, and you look at Equifax and it says that your score is 750. When you think about your credit score, especially as it relates to mortgages and car loans and those really big purchases that we're looking at, typically lenders look at all 3 of them. They don't just look at one, so they would be able to pull the highest of all 3. So I wouldn't get too caught up on one being higher or lower than the other. Eventually, they all even out in the end. So you might be thinking to yourself, well, how can I check my credit score? Thankfully, we live in a day and age that some credit cards and banks offer this as a free service. Like I said, going back to that Discover card that I had whenever I was in college, and I still have today, every time I log into my account, it actually tells me your credit score is X. And on the flip side of that, I have savings accounts with Capital One, and Capital One also offers me my credit scores. So again, those vary, they differ depending on which agency they're pulling my credit report or my credit score from. So I try not to get too caught up on that, but really just make those best decisions that I possibly can. The other thing that you want to do is to pull your credit report from annualcreditreport.com. I know this sounds sketchy, and I really wish that they would call this annualcreditreport.gov or something similar to that to make it seem a little bit more reputable and credible. But it is, if you Google federal credit or credit report, federal government, this is the website that they back and that they support. So you can go pull your credit report from annualcreditreport.com, and that will be a listing of any account that has ever been tied to you and your social security number. So that will have credit cards that maybe you've closed in the past. It will have any other loans that you've had paid off, any current loans, anything like that that is actually related to your credit will be on your credit report. So again, the longer and the older you get, the more credit you build up, that report will continually get longer. The biggest thing that you want to do is you want to pull your credit report and check it for errors. As you know, we're all in a very high period of identity theft right now. And thankfully, again, a lot of our cards that we have available to us do check for security breaches. They'll tell you, if your social security number was run and any breaches are found anywhere. But it is always a really fantastic idea to check your credit report for errors and make sure that you don't have any identity theft. The other thing that you can do is you can go to each one of those credit reporting agencies, again, TransUnion, Experian, and give me just a second. I'm sorry, I always get them confused. I'm going to go back here. Sorry. Experian, Equifax, and TransUnion. You can go to each one of these websites and pull a credit report for free from each one of these sites annually. So essentially, you can pull your credit report 3 times a year. All right. So oftentimes, when we go back to that piece of the pie and you remember that however many times you open a credit and your credit is pulled, that is what we call a hard pull. So that negatively impacts your credit score. Now, a soft pull, on the other hand, is not going to impact your credit score. So like I said, when those credit cards are showing you what your credit score is, those are soft pulls. Those aren't negatively impacting your credit score. If you want to go shopping for rates for a car loan, maybe you want to look at a few different banks. They will, if you do it within a certain period of time, those will be soft pulls. Let's say that you have a 2-week period and you're going to check Capital One, you're going to check PNC, and you're going to check Chase to see who has the best rates. All 3 of those are not going to affect your credit at once, because you are shopping and they do allow you a time to shop for rates. But when you actually open that loan and they pull those credit scores for the loan, that will impact your credit score. The score will usually decrease, but it will rebound after a few months. So again, when you think about renting, sometimes landlords will pull your credit. That will be a soft pull. They just want to see what your score is to know if you're going to be a reputable lender or a reputable renter, and pay your rent on time. Your insurance actually pulls your credit score to know whether you're a risky person to insure and that sort of thing. So there are a lot of soft pulls that are done on our credit score, but those hard pulls are the ones that we are really concerned about. So how do we diversify our credit portfolio? Any time that we borrow money, whether that be a credit card, student loan, personal loan, that is going to diversify your credit portfolio. And basically what the lenders are looking for is, do you have a diverse portfolio, or do you just have 5 credit cards? Or do you just have an auto loan or just a mortgage? They really want to see the diversity. They want to see that you are able to have all different types of loans and you're able to pay back all different types of loans. So that would include credit cards, student loans, personal loans, auto loans, mortgages. I like to play a game with my students called Credit Clash. And basically it shows that each time that they get an additional type of loan, they get an extra turn in the game. So it really is trying to diversify that credit portfolio and how you can best go about that and be responsible with paying all of those things back. So let's talk about credit cards for a second, because I think that oftentimes, and especially I see this with my students, is that people are really afraid of credit cards, and they can actually be a really fantastic way to build your credit and be used to your advantage, but you have to be disciplined whenever it comes to credit cards. So when we think about them, what are the advantage that we have? Well, we have the ability to buy items that we need now in case we don't have that cash right away. You don't have to carry cash. I don't know very many people that do carry cash anymore. Occasionally we'll do it for emergencies, but rarely, we've all got our phones or credit cards with us. It creates a record of purchases. Again, whenever you are using cash, unless you keep that receipt, you don't really have a way to create a digital record of those purchases. And another thing is that some people use their credit cards to consolidate their bills. So maybe you want to pay your electric, your internet, and your cell phone all on your credit card instead of having them come out of your bank account. So then instead of having three bills that hit your bank account, those 3 bills will hit your credit card, but you will pay them in one payment versus paying them in 3 out of your bank account. So those are some advantages that you have for credit cards. But disadvantages obviously are the interest. Right now, cards are going anywhere from 20 to 30% interest, which is really exorbitantly high. They could require additional fees depending on what type of card it is. Again, let's go back to that late payment scenario, that if you haven't paid, you can get a penalty, late payment penalty, and then have to pay $30 to $35. It's also really easy to lose track of spending whenever you are using credit cards. If you're using cash, you have $100, you get down to the last 5 and you realize oh, I only have $5 left. I've already spent 95. But when you have a credit card, it's just so easy to swipe and not necessarily keep track of how much you're spending. And then there is also that increased impulse buying that you're like, oh, it's okay. I don't have to have the money right now. I know that I can pay this in 2, 3, 4 weeks, depending on whenever your bill is due. So there are some disadvantages. You have to be really disciplined with credit cards, but you can use them to your advantage. So when we think about that and how do we use them to your advantage, there are cards that have gas and grocery rewards. There are cards that have travel rewards. And then there are cards that have cash back attached to them. And these are all really fantastic rewards. In our household, we probably have, I don't know, maybe 4 to 5 different credit cards, but they all have a specific purpose. We have an American Express that we just use for gas and grocery purchases because we get a much higher rate back in cash back on those gas and grocery purchases than we would with any of our other cards. So basically, I just transfer that money out of our checking account into a savings account so that I don't think that I have it there to spend. And then each month I just pay that card off. Our family really likes to go to Disney World. So we have a Disney card that we put purchases on, and we're able to use those Disney rewards to help pay for trips or things that we do at Disney. We have a Lowe's card because you are able to get 5% off whenever you use your Lowe's card at Lowe's. Target for the same reason that you get 5% off whenever you use it. But again, you have to be really diligent about paying these off each month. So what I recommend doing is, let's say that you make a purchase at Target, you went and bought, I don't know, $75 worth of things. Then you take that $75 from your checking account and put it in a savings account so that when that time is due to pay that card, you have that money set aside that you're able to pay it. And then there are some other cards that have great cashback rewards. Discover and Chase are a few of those that you are able to get rewards back. And you can either get those in the form of gift cards. You can get them as a statement credit, or you can get the cash back directly to your bank account. So I do think that credit cards can be used as a tool to benefit you, but they can also, you have to be really diligent about paying those off. Another thing that I want to mention is that you really need to be conscientious of the fees that are associated with some of these cards. Some of them charge an annual fee to use them. I'm really one of those conservative people that doesn't like to pay fees. I think that our Disney card might be the only card that we have that has fees, but you have to make sure that the benefits that you're getting from that card outweighs the cost of the fee. So if the fee cost you, I don't know, $50, you need to have more than $50 in cash back or rewards that you're getting out of that card each year to make it worth it for you to actually hold that card. Currently, there is this big movement about being debt-free. And, you know, a lot of people say that debt-free is the way to be. But when you think about playing the credit game, which is what this is, this presentation is really focused on, sometimes it's not necessarily the best thing to be debt-free. You know, I like to tell my students that when they're starting to build that credit, just go out and get a credit card and fill up their tank of gas and then pay that off that month. There are some individuals that have made really fantastic progress as it relates to personal finance and say, like, you shouldn't have any credit cards, you shouldn't have any debt at all. But it's really hard to build a credit portfolio when you don't have any debt. There are also people who pay off their mortgages and realize that their credit scores go down. And they're like, what's going on? You know, I just paid off my mortgage. I feel like this should be something that benefits me, right? But again, when we go back to that pie, go back to that matrix, they have now just decreased their available credit because they paid off that mortgage. And they've also eliminated one of their types of credit in that diversification. So I'm not telling you all to not go out and pay off your mortgage, because again, that is my goal one day, is to be completely mortgage free. But I just want you to know that when you think about the credit game, because it is what we're playing here, is that sometimes being completely debt free is not always the way to win at the credit game, but you have to be extremely responsible as it comes to having debt. And I just saw a question pop up here. Oh, this is actually a really great question. I have a store card that I don't use anymore and it's paid off. At what point can I close this card? Ideally, you can't close this card. Sure, you absolutely can. But it is going to negatively impact your credit score. It will reduce your available credit that you have outstanding to you. So that would actually, again, negatively impact your score. So if you want, you can leave it open. Sometimes credit card companies close them altogether after inactivity. This is one of my personal pain points, because I'm like you, that if I had a store card, I don't use it, it's paid off, like I just want to close it and forget about it. But again, that does decrease your credit. So it's really up to you if you want to allow your credit score to drop, but eventually it would jump back up at that point. How long after closing an account will your credit score rise after the drop? It's usually anywhere from 6 to 9 months after that time period. All right. So in summary, I would like to point out that borrow only what you can repay. That's really when people get to be in these situations that are unmanageable. You know, If you know that you don't have the money to repay this by the time by the time the statement comes due, it's probably not something that you need to be buying right now. Save up a little bit, and then be able to purchase it at a later time. And this is another really great one to read and understand the credit contract. What is your annual percentage rate? And I think that a lot of us are really guilty about using credit cards and not understanding what the rate is, what the percentage rate is right now, and how that works. So I highly recommend going and checking your cards to see what the rate is that it would charge you if you didn't pay things off. Again, pay your debts promptly, make sure that those are getting paid monthly. Notify a creditor if you cannot meet payments. This is something that we really struggled with early on in COVID when people lost their jobs, and were struggling to make ends meet. But really the best thing that you can do instead of going into default with any of these loans is notify the creditor and see if you can come up with some sort of plan to make it through until your income goes back up to a normal level. Make sure that you report lost or stolen credit cards promptly so that you don't have to deal with purchases that you didn't make. And again, a lot of those cards are putting a lot of identity theft things in place. I had a friend who bought a new house, and so she put some furniture on a new card and on a credit card, and the credit card company called and said, "This is an odd purchase. Is this you?" And she said, "Yes, it was me." But they do have a lot of really fantastic support around the unwanted purchases that someone takes your card at that point. And obviously we always have to be cautious of giving card information over the phone. Now there are text scams that are going out as well. Just be very careful about what information that you give out over the phone as it relates to your credit card. And that is all that I have. So I will stop sharing and allow for questions. When I am paying the credit game, if I'm able to pay off my car loan early after getting the loan, no. So when you think about car loans or mortgages, early payment is not going to affect your credit score. Pay it off and be done with it. Pay it off early to avoid the interest. I'm always a big proponent of that for sure. When you think about term loans, those actually act a little bit differently than credit cards do. If you close a card, that definitely closes your availability to purchase more because you do have that limit. But when you think about car loans, those are term loans. Those are obviously going to be closed at some point. So if you can close them earlier and pay it off early, yes, save yourself that interest.
All right, Amy, that was a wonderful presentation. I know a lot of you have asked questions throughout the presentation, and I was going to get to questions that were submitted earlier. So did anyone else have any other questions before I pull some questions that were submitted beforehand? If you have your questions, you can use the Q&A section and ask away. Amy gave a lot of great tips on credit, the advantages, disadvantages, and just how to use it wisely. So, Amy, one question that's coming from the registration form, or it was in the chat earlier, I moved it to the form. It says, can you build a relationship with a particular lender despite your credit score?
Yes, so I think that that's one of the best things that you can do. If you have a bank or a relationship with a specific institution, obviously they know that you have accounts there. Try to keep those accounts in good standing. Don't overdraw those accounts. Show them that you're able to continue building that credit, and they might be more likely to open an account with you as far as a lending account with you, based on your ability to keep a steady bank statement a bank account that they can see.
Awesome. All right. So relationship building is very important when trying to build credit and get a bank or financial institution to give you a loan at a good interest rate. That's a good
Absolutely.
question.
And when you think about that as well, think about credit unions or maybe smaller financial institutions that you can really build that relationship with. When you look at the Wells Fargo and the Chases, they're very numbers based and not necessarily relationship based. I'm not saying that about all branches by any means, but when you look at them as an institution as a whole, you will probably be able to build a better relationship with a smaller bank or a credit union that might be able to offer you some better rates.
Awesome. Awesome. That's a great tip. Smaller banks or financial institutions. All right. So the next question that we have is, how can we be disciplined with paying the credit card after we use it? How can we use credit cards for travel hacks? So I know you touched on a lot of this throughout your presentation. But the first part of the question, how can we be disciplined with paying the credit card after we use it? I struggle with that, but I didn't know if
Yeah.
you had something to add.
I also struggle with that. I will be 100% transparent on that. But what I found to be the easiest thing is, like I said, if you use a credit card and you have that money in your checking account, move that money to a savings account so that you don't see it in your checking account and think that you have double the money to spend, right? Like now we've just moved it to our savings account. It's out of sight, out of mind. And then when it comes time to pay that credit card, you just pull that money out of your savings and put it towards the credit card account. So that is my biggest thing, is as soon as you make that purchase, just go ahead and transfer that money over to a savings account. Let's say that you have something, I don't know, maybe it's a bigger expense. For instance, my husband just bought a grill. He just bought a new grill. And so for that, I know that my credit card statement isn't coming for the next 4 weeks or whatever. So I might divide that grill payment into 4. And each time that I get paid, take that fourth and put it into the savings account so that when that does come time to pay it off, I've got that money out there, but I don't feel like right now I have to take that whole chunk and put it in a savings account. I would use the smaller transactions for immediate uses, but if you have a bigger transaction that you can pay over the next month, take that out as you get paid.
Awesome. Awesome. And I'm glad you mentioned that. It made me think about what I do. So I think that I'm a little weird when it comes to credit cards. So if I'm using my credit card today, and let's say I go to Target and I spend $100, what I'm going to do is within like 3 to 5 days, I pay it off. And
Mm,
that way at the end of the month, I'm like, oh my God, I don't have a big credit card statement. I
yeah,
always do that. I try to wait until it's like posted and then I'll like
yes,
pay it off. But
absolutely.
like making sure that I have the money before I swipe my card is very important. Doesn't always happen because life, but I
Sure,
want to make sure that I am intentional about that. The
absolutely.
other
And I'm going to add on to
Mhm.
that.
Yeah, go for it.
That other question. The other thing about that is, let's take Target. Target doesn't give us rewards for our cards, right? So, in that situation, you would want to wait for it to post and then pay it off. That's fantastic. But let's say that we have a Discover card or we have a Chase card. Sometimes those purchases don't accumulate those rewards, those cash back things that we're getting until the statement post. So that might be a reason that you would actually want to wait and not pay those off right away. But again, this is all dependent on your credit card company. So that might be something that you want to chat them about, do an online chat or call them, say, when do I actually get rewarded? If I paid this off in the next 2 to 3 days after it posted, will I still get the rewards, or do I have to wait until the statement post for me to get those rewards? So that's something that you want to be able to check into.
Awesome. Thank you for pointing that out. I had no idea of that.
Mhm.
The other part of that question was, how can we use credit cards for travel hacks? It's great.
Yeah, absolutely. So, like I said, our family is a Disney family. So, we are currently trying to plan our next trip. So, all of our purchases when we eat out or do anything are going on that card so we can get rewards. Maybe you fly a lot. So, you want to look into a Chase Sapphire that's a travel card. Maybe you want to look into a Southwest card because you fly Southwest all the time. There are various cards that are specific. You can get a Marriott card if you stay at Marriott all the time. You just have to, I really think the best thing, and I hate to say this, is to just Google what travel cards are best and then find what works best for your specific needs. We're not a family that flies very often. We usually drive most everywhere. So I'm going to look for travel cards that are going to give me hotel points and that sort of thing versus a card that for a family that might fly all the time. So everybody has different needs and different ways.
This is awesome. And I want to add something like, I think when I was looking for a great credit card, I have a Capital One Venture card now that has
Yep.
that I don't
Mhm.
like, but I love
Yes.
it so much because I can use my points for gift cards, Amazon purchases. I can use them for Uber, Lyft, hotels, travel, all of that. And I did a
Sure.
simple Google search, like Capital One Venture versus Chase Sapphire, and it showed
Mhm.
like all of the pros and the cons and things like that. It took
Yep.
me a while, but I definitely I love the card, and I had to have a specific credit score to even get
Mhm.
qualified for the card.
Yep.
So I thought that was something great to add to that as well. So
Absolutely.
yeah, let's see here. How to optimize a credit portfolio when having good credit. I know we touched on that a bit. Did you have anything else you want to add to that?
No, I mean, I think that basically the best you can do is diversify your credit. Do you have a car loan? Do you have a mortgage? And I don't necessarily think that all four of the, when you look at student loans, credit cards, auto loans, mortgages, I don't think that all four of those are necessary to have a good score, but do you have a mix of them? There are a lot of people who don't have any car payments, and I highly suggest that because car payments are the worst. but but at the same time, I'm not going to go out and open a car loan just so that it builds my credit score. Like, this is a give and a take, right? And you have to figure out what works best for you. But I would much rather have my credit score not be increased by 10 or 20 points and save my $500 a month in a car loan, in a car payment. So,
Yes. That's a great point. I hope you guys are taking notes because I'm sitting here listening and I'm also taking notes. Um, there are a couple more questions, and if at any time you guys have any additional questions that pop up, you guys can use the chat or the Q&A. But the next question that I have: how to purchase a starter home with bad credit?
So I will say the mortgages are the hardest things. When it comes to getting a loan, they're going to pull your tax statements for the past 3 years. They're going to pull pay stubs. They're going to pull your checking accounts. They're looking at every single detail of your life. I like to say that it's really looking at your financial well-being naked, right? Like, they are stripping back all the layers. They're looking at everything. So that the best thing that you can do is to speak with your lender, go get pre-approved, see if they would even approve you for a loan. If not, they will give you tips and tricks about certain things when they look at your credit report to know things that you can improve on. And maybe that's just continually paying your bills and you have to wait 6 months to a year to build that credit up a little bit more. But that is something that it's just kind of a waiting game, and you have to continue those positive behaviors to build up your credit before that lender may give you a loan or not.
All right, awesome. And then there is a question in the chat. As a graduate during COVID-19, I got myself into $5,000 worth of debt. What are some suggestions to pay off that debt? So Amy, did you want to grab that?
Yeah, absolutely. So I would assume this is credit card debt. Can you confirm that? Yes or no? Yes. Okay. So the best thing that you can do is right now you have a minimum payment, and that card will say you have to pay X amount of dollars per month. Always pay more than the minimum. Sit down and really look at your budget and where are some ways that you can cut. Maybe you are eating out 2 or 3 times a week, and maybe you could cut that back to only once a week. And then you would take the money that you would be spending on those other 2 or 3 times and put that towards your debt. Maybe you can go through your closets and sell some clothes that you're not wearing anymore. Or if you have kids, maybe you want to sell some of their things that they've grown out of or toys. What can you go through your closets or your house and purge, maybe sell on Facebook Marketplace, that sort of thing, try to get some extra money as far as that goes, and really look at your budget and see some places that you could cut or allocate money to that debt instead as well. Does that answer your question? Hopefully.
All right. And then the last question was about rebuilding your credit, but I know you just touched on that and you talked about how, depending on your situation, it could take up to 6 months, and depending on what it is, what type of credit it is that you want to rebuild, what just happened. Did you just buy a house? Did you just buy a car? Did you close a
Absolutely.
credit card? So it all just depends on your specific situation. That
Sure.
was the last question.
So I think that my last piece of advice that I would give to everyone is to not get hung up on this score. Like there are so many people that are trying so hard, and every month it's a moving target, right? Like it's going to change every month, every week, every day, depending on that credit utilization. Maybe you just had a really big purchase and you put some plane tickets on a credit card. Well, obviously that's going to increase your credit utilization right now, but in a few weeks you're going to pay that off and then it's going to be back down. So you cannot get caught up in what that score is and worrying about what that score might be. But really, as long as you're trying to make better habits, that's all that we can really ask for as it relates to your credit score.
All righty. Were there any other final questions? This was amazing, lots of information. I hope you guys enjoyed it. Amy did a wonderful job. Like I said, I took a bunch of notes. Is there any other questions before we close out for this afternoon? Going once, going twice, anything you want to ask?
Yes, it will be sent out.
Awesome. Okay. All right. Awesome. Amy, thank you so much. This was definitely a great
Absolutely. Thanks for having me.
conversation. Yeah, this was amazing. I know we will definitely be utilizing you more for financial literacy because this is your area of expertise. We appreciate it so much. I want to be respectful of everyone's time. We are a little bit earlier than 1 p.m. ending. So in the chat, you will see the calendar that has other VC alumni events. We have 2 more sessions for Financial Literacy Month. One is next week on April the 19th, and then it's one on April the 26th. So if you want to join us for those financial literacy sessions, you want to click on the calendar, which is in the chat. Also, if you're interested in connecting with alumni, or even if you're interested in sharing your knowledge to students and fellow alumni, we would definitely encourage you to join VCU Link at link.vcu.edu. You should see that in the chat as well. VCU Link is VCU's online community for connecting students, alumni, and friends of the university for career advice, industry contacts, and meaningful professional relationships. Also, follow us on social media if you have not already. And you should also see a survey in the chat box as well. This is important that you all complete the survey so that we know going forward what types of webinars, presentations you want to see from us. We read all of the surveys and we take everything that you guys are submitting into our staff meetings so we can talk about how to build programming that you love. On behalf of VCU Alumni Relations, thank you so much, Amy, for this valuable information. And thank you so much, everyone, for joining us today over lunch. I hope everyone has a great rest of their day, and go Rams.